Primary thing I kind of want to go over is day trading technicals. Since all of your premium members, you know that a lot of times I do share intraday setups, and sometimes they can be very, very quick. So I definitely want to make sure that everybody has the knowledge they need to kind of take those ideas and profit off of them, or if you don't profit, at least manage your risk in the best way. So I'm kind of going to start off with kind of just showing you all how I look for day trades and what the strongest types of setups are. After I do that, I'll talk about risk management and scaling and options. But yeah, so just the first thing with day trading, really the main thing you're focused on is all the time frames on your chart under the 1 hour. But before you enter day trades and when you're scanning for day trades, sometimes it does help to take a look at the higher time frame charts. Now, the only reason I'm really saying that for is just to get some context, because sometimes you could use a daily, let's say, support level as one of your theses or one of the reasons behind your day trade. So if we take a look at this chart right over here, JWN, you can see at this 33 level has been support many times historically and even resistance. So this is a pretty important level. So right when you get to this daily chart, you can see that, right, maybe if you're taking a day trade on this, you can have a stop loss under that level. Or maybe if it comes down to that level, you can get in right around that support. So you kind of want to start off with just looking at the bigger picture. And then when you kind of get the context of the overall trend for the stock, if there's any supports or resistances on the daily, maybe even moving averages, that's when you go down to lower time frames. But I wouldn't look for any patterns or anything other than support and moving averages on the daily if you're day trading. That's really all you need. The patterns and everything else will come from the lower time frames. So once you kind of figure out the context of your day trade, that's when you go to the 1 hour. Now I use pretty much the 1 hour, 30-minute, 15-minute, and 5-minute. I don't really use the 45-minute, but the strongest day trades come from when all of those time frames that I just talked about are kind of showing bullish variables. And very often you're going to be seeing, you're going to have completely different variables on the 5-minute compared to the 15-minute. And that's actually a really good thing. So, you know, I haven't looked at this chart yet, but we can just kind of take a look at the 1 hour, see if we can find anything. Maybe we talk about it in past context. So you can see, I'm going to put a little bit of a square over here. You can see on this red candle right over here, on the 1 hour chart, you kind of pulled all the way back down to that $33 level that I was talking about as support on the daily. Now, once you came back down to that support level, you can also see that it wasn't too long before that your MACD went back to green. So you did get a MACD crossover. Some other things, you have a bullish engulfing candle a few candles prior to that. You're right around the 200-day moving average. And then one last thing, on the 1 hour, you can see have a little bit of a gap fill. So I'm just bringing up a bunch of different things as like an example. You're going to get a variety of different technicals, but you're just looking for as many as possible. So you kind of look at your 1 hour chart, you look for all the different technicals that I talk about in the streams and in the course. Then you go down to your 30-minute chart and you kind of look for if there's anything different there. Maybe over here you could kind of see a little bit of a double bottom off the support. So you see it tested that support the first time, bounced off of it, and then right when it pulled back down to it, it was holding it again. All right, so let's go down to the 15-minute now, see if we can find anything there. A little bit of bullish convergence on the MACD where you made a higher low on the price and on the MACD and on the RSI. So your oscillators look good on the 15-minute chart. Anything else? Let's see. So again, we're kind of looking at the trade like it's right over here. And that's really it. So if we go down even to the 5-minute chart, you're just looking for as many variables as possible. So for an example here, you almost have hidden bullish divergence on the 5-minute chart. It's not perfect because you kind of made the same low on price. But again, I'm not really trying to dive too deep into what all the technicals mean. All I'm trying to do is let you all know like how many things you really want to be looking for, because very rarely you're only going to be trading one time frame and one pattern. Typically when you're taking on a day trade, you want to be trading multiple time frames and multiple different setups on each time frame. And while you're doing that, it's kind of a situation where you have to be quick, because unless you're taking like a 3 to 4 hour trade, which typically you don't on day trades, you want to also, while you're looking through all the charts, be lining up the actual stock price. Now, I'm sure you all know mainly for day trades, I trade options. Now, you don't have to do that. The main reason I prefer trading options as day trades is because, for one, the Greeks don't really affect you if you're day trading options, because those kind of work more overnight, or if you're swinging options, unless it's like a lotto call, then the Greeks will affect you. But it just allows me to use less money to get the same type of result. So, to get, let's say you have $100,000 account and you want to make $1,000 in profit on a day trade. if you'd have to put your whole entire account into that day trade and get a 10% move on the stock price to make $1,000, right? Or that would be no, that would be a 1%. So you need, let's say you wanted $10,000 in profit, right? You need to do pretty much a 10% move. Now, if you do it with options, you don't have to use your whole account, and you can still get the same amount of money with a much higher percent, right? So it allows you to, it's pretty much just leverage. It allows you to use less money and you can make more money with that. Now, what's the flip side? What's the risk there? You're obviously risking more, but if you have good risk management, you can kind of put yourself in a position where you're not. Now, I'm going to go more into risk management a little bit later, but that's just kind of my personal thesis behind day trading options. It's not for everybody, but if you are day trading options, you also need to know how to pick them. So let's assume that all the technicals are looking good on the charts that you're looking at. The volume is also there. It's one thing I forgot to mention. Always look for good volume on your entries. You want to be entering when other people are entering, because that's pretty much the trade. You want to be in the same boat as other people, because a lot of times millions of day traders around the world will be looking at the same exact supports as you, at the VWAP and a bunch of different things. And typically, when you see a pattern breaking out intraday or something, a lot of other people will be trading that same pattern, especially the very clear ones. So once you get all those kind of confirmations from technicals and volume, that's when you try and pick your options. Now I'm going to talk about that in a second here. L-Train in the chat says, what's a good volume percentage of the 10-day average? I wouldn't necessarily look at it as the 10 as a 10-day can't talk as a 10-day average necessarily, because really you're only in for a short amount of time. So I mean, yes, it would be good to know if there's something more impactful happening, maybe if there's a catalyst that came out in the morning and you're day trading in the afternoon or something. But what I would be more concerned about is, since it's a day trade, you'd be looking for the highest volume of the day. So we were talking about, for an example over here, entering around this green box on the second bottom at this support, right? Now you can see I wasn't just thinking that in hindsight, but people were thinking this as it was happening in real time. You can see on this candle over here, as it was finally bouncing off of that support again, your highest volume of pretty much that session came in right over here. So that's more of what I was saying before, where other people are looking at the same exact thing. I highly doubt there was any catalyst here. I really just think that it bottomed once, it bottomed twice. Many people were trying to get in on that second bottom. It broke back above the VWAP, and that's why that volume spike came in alongside the price spike. And if you notice one thing, this volume bar over here came in on the candle before the price went up. That's very important here. It's not like the volume came in and the price went up and then you have to chase it. The volume actually came in before that. The volume came in on this little candle. Now, what does that mean? That means on that volume spike, there were a lot of traders on both sides of the ball, because technically that candle closed lower than it opened. It's a red candle, but there was a lot of volume in it, which means people are kind of entering into the trade, but it might be faking out non-technical traders, right? Because you were falling down in price, you got to bounce back up, and non-technical traders might just be trying to cut their losses and get out. But technical traders see that, and that's where they were actually entering at. And then what happens on the next candle, the buyers overweigh the sellers, and then you get your price bounce, and this would probably be your trade. Even if you missed the initial trade, what happened? It came all the way back down, right? As the buyers took their profits up here, it came all the way back down and you made a higher low. And then what happened again? You ran for pretty much the rest of the day until it filled that gap that we were talking about earlier on the 1 hour chart, and that's where it kind of settled off at. So those are all the things you kind of look for on your trades. Now, if you're just day trading that with regular shares, it depends on how much capital you're using. That'll be whatever your profit is. But if you're using options on that, that's where you can kind of find a nice profit depending on how much money you put in. So when it comes to picking options for day trades, it really depends on your preference. Typically, if I'm going to be doing just a day trade, I'll just go for the weekly options, because that's just going to, the delta and the gamma and all that won't matter too much, not even the IV. But what kind of will matter is just the leverage that you're getting. So typically, let's say I wanted to trade Clover on a day trade on Monday. I would probably get the August 27th options, because I'm already confident in some sort of a move happening during the day. So there's not really any point for me to go further out, unless I want to put myself in a situation where I'm going to be risking less and making less. So even if you want to be a little bit more conservative on day trading options, that's when you actually can use further out contracts, just so that in case like a crazier move happens to either side, you're limiting your risk and potential profit by a little bit. But typically, if I'm day trading options, I don't really care about any of the Greeks. I don't really look at them too much on day trades. Maybe the only thing I'll look at is the IV just to see if there's some sort of, move already priced into the options, but very rarely you're going to have weird things happen with the options. I'm sure some people remember last week we had the Clover calls being very, very weird. Like the stock went up, I think 4% or something, and the options were like the same. So very rarely it'll kind of screw you over if you don't look at them. But most of the time it shouldn't matter too much. In terms of picking, I already talked about the date. I just go for kind of the weeklies. In terms of like picking the strike price, it depends on what you're looking at. Now, typically, I will go in the money if I'm trading something that's testing a support. So for an example, if I was looking to enter options right over here, I would actually go in the money. Why? Because there's no guarantee that it'll actually hold the support, right? So if I'm playing off of an exact support level that I'm entering right around, I'll typically go either at the money or in the money. And that's really if I'm judging the majority of my trade around one price point. If I'm not doing that, and let's say I'm playing a pattern or a harmonic or divergence, that's when I'll actually go slightly out of the money. Now, typically I don't go too out of the money because again, it's a day trade, and on day trades, you usually don't have the craziest of moves on the actual stock price. So I usually go either for, trades right at support, I'll go at the money, or one contract in the money. For trades that I'm playing more complex structures on, I'll go slightly out of the money. Like pretty much the closest out of the money contract is what I'll get. Most of the time, regardless on a day trade, all the contracts will move if you're right. So you're still going to be walking away with some profit, but obviously you want to pick what works best for you. So again, probably just look at the IV first, see if it's a little bit high. There's also a lot of other websites you can use to kind of see if the implied volatility is higher to the past, because that can affect your options. Sometimes you also want to see how the options have been doing during the day, kind of compare the low on the options to the low on the price, and just kind of, use math to see how the options are moving with the actual price. And one thing that can kind of help you with, or can kind of help you out, is learning a stock. Now, if you've been in premium for a couple of months, I'm sure you've heard me say an endless amount of times, Clove calls idea, not financial advice, and then I send the charts over. But learning an actual stock is what can give you an advantage in understanding the options as well. Because when you're staring at options, you kind of subconsciously start remembering patterns in your brain. When you're looking at price action, you kind of start subconsciously looking at patterns, right? I could not be able to draw on charts at all and just look at the candles and take trades, right? I could have my hands tied behind my backs and just take trades just looking at how the charts are moving. Why? Because after doing the same exact thing every single day for a long time, you start to notice the patterns of stocks, especially stocks that you look at on a day-to-day basis. So that's really what I do in terms of looking for options. It's not too complex. There's no really secret behind it. It's just picking the contracts that make most sense to you based on the price movement that you think can occur. Go ahead.
I wanted to ask.
Can you repeat that 1 second?
Yeah, the question.
So probably the most important thing that comes with both of those is the spread. Obviously, I'm sure you hate wide spreads. I'm sure anybody does that trades options. But it always is nicer to have a good open interest and volume. And again, there's other websites that kind of show you how those develop over time. I think TradeAddicts does, but what mainly affects me is if you're getting something very, very unusual occurring. So if you're looking at it in real time and the volume is just heavily over increasing on the open interest, that can kind of tell me that people expect some sort of a big move, right? Because if the amount of contracts being traded by the people who are already in those names is large, that means they either want to get out or they want to add to their position. So I don't really look at those on day trades too much. I typically look at them if I'm like overnighting options or something. But they definitely can be helpful if you want to see if other people are expecting the same thing as you, if that makes sense. It's just typically I don't see too much of a change from the time that I look at the open interest and volume to the time that I take my trade. So the only thing that you could kind of get out of that, apart from just looking at the change, is just seeing if there's more people in them than usual, right? So it's more of like a historical thing.
Spread, but
Yeah, I mean around that's good for me as well. Typically, I the most I'll ever go is like a 5 cent on the premium. So sometimes, especially, I've traded a lot of UWMC calls in the past, and those typically around 5 cent spreads. And really the only time I'll trade those is if the stock is going down, because if the stock is going down, it's easier to get filled on the bid than the ask. So I'm very, very picky with that. And again, like I always say, especially with trades in general, you never have to compromise. So there are going to be times where you're trying to get filled at the ask and then you never get filled at all and the trade goes without you. Let it go without you. You'll find another trade. But you do not want to be putting yourself in the position where every single time you enter an options trade, you're starting off down 5 to 10%, right? That should only be like a very rare thing when the stock price is already moving itself and you're trying to jump in alongside it. So it's like you're trying to bring all these things together at the same time, um, and using your confidence, but also your mind about that. Another part about day trading is having the good psychology, because where I feel most people kind of mess up is they understand the technicals, and if you're trading options, they understand that as well. It takes a couple weeks to learn them, and you kind of just practice and practice. Well, probably the hardest thing to learn in all of trading is just having a good mindset, because I'm sure you've all been there, selling too early, being too greedy, all the different things that you can kind of screw yourself over with when you're seeing either profit or loss, right? So in either direction, you always have to remember in day trading, like you're only in for a little part of it, right? When you're day trading, your only job to do is make money. So I feel like a lot of people worry about, wow, I could have doubled my money if I stayed in for another half an hour or whatever the case may be. That's not your job to worry about. You're only trading a specific pattern, support, resistance, and whatever you make is what you make. You kind of get paid for the job that you did, if that makes sense. So if your job was to play a secondary test of support and look for a gap fill, it's your job to take profits when you hit your target. As a day trader, you have to follow a plan. And I'm sure you've heard that from many other people, but there's a reason why everybody sets that. Because if you're not following your plan, all those mistakes are going to start piling up on you, and what's going to do is it's going to affect you mentally, and you're going to start losing confidence. And you want to be a confident trader. When you're not a confident trader, you play scared. And when you play scared, again, more bad habits come. Either you're selling too early, or you don't want to take your losses and you just want to cost average and cost average and cost average, and then you're down too much and it never goes back up. All you want to do is have a set entry, exit, stop loss, and whatever hits first is kind of what you take. So that's really, the main things you're looking at. So we got about 10 minutes left in the lecture. I already kind of talked about the technicals and the options picking. So now I'm going to be talking about scaling in and out and risk management. I'm already kind of getting into risk management, so I'll just continue with that. If you are day trading options, in terms of risk management, I cannot tell you what percent to risk, but typically I have a combination of two things. One, a dollar amount or percent amount that I'm willing to risk, and then two, the price level I'm willing to get out at. And what I usually go by off of first is if one of those two limits hits. So every time I go into a trade, I'm going to first off have either a dollar price that if it gets down to, I exit the trade. For example, on this JWN, if it breaks under, let's give it a 1 to 2% room. So if it breaks under 33 bucks, I'll exit the trade. It most likely broke the support. It could head back down to the next support. On the flip side, a percentage risk. Now, the percentage risk for most people is pretty much very common amongst all their trades. For me, on options, on day trades, I risk about 25 to 30%. Why do I do that? One, for a percentage of my account, and I'm obviously not going to say it, I'm willing to risk that money every single day. And then two, just historically, I've seen a lot of times where my options might start down 15 to 20%, and then they run all the way back up and it becomes a profitable trade. But on the flip side, I've also seen personally, a lot of times when I've gotten down to the 30% mark, and I haven't gotten out of my position, I've seen those drop down to 50%, 60%, 70%, because again, they're options. So it's kind of just a simple saying of cut your losses and let your winners win, And again, that 30% number might be a 10% number for one of you. So I'm not telling you what risk amount is best for you, only you can kind of figure that out yourself. Probably the easiest way to figure that out is divide up your account into how many percentages you want to allocate to each trade, and then you divide that up again by how much you're willing to risk on each trade. And then once you kind of figure that out, whatever the dollar amount is, you have to be comfortable with risking that every single time you take a day trade. So it's really a fine line of not being too greedy, but not being too risky, right? And that's really obvious, but it's hard to do it when you're kind of looking at technicals and charts and options intraday. Sometimes you forget about something, and your job is to be, fully aware of everything at the same time. You have to be aware of the technicals. You have to be, if you're trading options, you have to be aware of the premium on them. You have to be aware of your plan that you had going into them, and you have to be aware of when it's time to get out. So that's really how I go about cutting losses. In terms of taking profits, like I said, I look for a target, but scaling is important, especially on day trades, in my opinion. Another fixed number I have is if my options go up about 20%, I usually sell about a quarter of my position. So if I have options that go up about 20% since my entry on a day trade, what I'll typically do is immediately, not because of technicals or anything else, just because I made money, because I was right to some extent, let me take some profit. Let me be a little bit happy even if things don't go up higher. So what I usually do is I take my profits, and then I've already taken profit. If you're taking profit on a trade, why should it turn into a losing trade, right? You were taking profit for a reason. So once you take that profit, when you get up to a certain amount that you're comfortable with, being happy with, you win. You win the trade. Now, I'm sure many of you don't see that currently. You might be taking profits up 20% on like a fifth of your position or a quarter of your position, and then it goes back down and it hits back to your entry price. And then maybe you add back in. You say, oh, I already took some profits out. Let me put that back at the entry, and I'm playing with a little bit of house money as well. I can't tell you what to do. I'm not a financial advisor, but for me, that's just not how I do it. If I'm taking profit at a certain level and it's getting back down to the point where it's about to be a losing trade potentially, I get out, because my job, like I said, was to make money. And even if it's not as much as you initially hoped for, at the end of the day, you made the money. So that's just typically my mindset about taking profits. Up 20%, I'll take a fourth or a fifth of my position off the table, move my stop loss up to the entry. Then that's when I just go with technicals for the rest of my trade. I already took some profit. Even if things go wrong, I'm walking with some money. So I don't really have to worry about the percentages. Then I worry more about the technicals. I watch the charts. I see if a support is holding or if a support is breaking. I see if there's bearish divergence or bullish divergence. I see if there's bullish or bearish patterns, all the things we talk about. Again, I don't want to go too deep into actual technicals on this. I'm just using them to kind of give you some context around day trades. So that's really my idea about scaling. Very rarely I'll just continue cost averaging. The only times I really like nonstop cost average is if I already know going into a trade that it could be a volatile one, and also if I'm not really at my risk level yet. So let's say I enter this trade, and instead of bouncing at the support, it went another 1% under. Maybe I'll add a little bit more to my position to get a better cost average, but again, you have to have a fixed number. Going into every single trade, you have to have some sort of a plan, at least in your mind, about how much you're entering with, where you're getting out, at what percent or at what price point, and then where you're exiting if it doesn't go your way. But also, you want to give yourself the ability to be a little bit optimized around the price. That's why I never really fully enter options trades with 100% of my intended capital. Typically, again, like I said, divide up your account into how many ever amounts you want trades with. Let's say for me, it's about 45 trades is what I divide my account up into, right? So, 20%, 20%, 20%, 20%, and then the final 20% would be cashed. So I can cost average if needed. Now, cost averaging for me is kind of the only backup I have in trading. Cost averaging is not necessarily me doubling down positions. All it is slightly and slightly increasing my position as the price goes lower until it gets to my risk level. Even if I'm cost averaging and it gets to my risk level, I still get out. And that's why I don't like cost averaging too much, because if you do that, you're increasing your loss as it goes further down. So the most optimal trade ever, just to recap everything, is your 1 hour, 30-minute, 15-minute, 5-minute. All of those charts are lining up, showing different but also bullish technicals. Going over to your options train, if you are day trading options, you get a nice spread on your options. The IV is not insanely high. It's at a good price point. You get filled well. Then you take some profits as you start making money, and then you look for the technicals as it keeps riding up. You let it win for a little bit, but don't get too greedy. If it doesn't work your way, how do you kind of do the best out of a losing situation, right? You can notice pretty early in your trades that it's not working out. If you are not noticing early when your trade is not working out, you need to work on that. Now, how do you work on that? You got to start learning your supports and resistances. You got to start learning your patterns. One thing that a lot of traders fail to do is, if they're bullish or bearish on a stock, they get very, very narrow-minded. You can be bullish going into a trade, but change to bearish during that trade. You're not signing any contract saying you have to stay bullish forever, right? Your job is to identify if something looks bullish or bearish. So you cannot kind of block out the other side just because you're going long on something. During your trades, you have to give room to both situations, right? So you kind of got to create a mixture of the two. And, I think that's most of the points I wanted to cover on day trading and options. So we have about like 2 minutes left in this call. So what we're going to do now is I'm going to end this recording. I'm going to end the call. And in the Discord, in the same exact channel I already shared this link in, I'm going to put in a new link. And basically, if you want to join back for a Q&A and just talk to me for probably like another half an hour, you can join back. If you just want to be here for the lecture, then I really appreciate you all coming out. And yeah, so I'm going to end this Zoom call. I'm going to share a new Zoom link in the Discord.